And so I think when people look at what the Fed's doing, the Fed is going to keep raising until there's a panic and until people are having to liquidate these investments that they really never should have bought. And then you're going to see something shift. And
everyone's wondering what the Federal Reserve is going to do next. Are they going to make us richer or poorer? And what's going to happen to the markets as a result? E.B. Tucker joins us today. He is the editor of the Tucker Letter. Welcome back. Always good to see you. How are you?
Thanks for having me.
Your latest piece in the Tucker Letter, How Steroids Ruined Capitalism. A very important piece. I encourage everyone to check out the Tucker Letter. You were writing about QE and its negative effects on the economy. Do you think the Federal Reserve is going to go back to zero interest rates, more QE, more free money, more money printing, things that will make us come out of a recession?
Yeah, so the problem with steroids is that you get huge arms or something, and then other parts of your body quit working entirely. And so eventually the doctor tries to explain to you that, the huge arms really didn't pay off, because your other organs started failing and all these things started happening. So you get all these unintended consequences. And so what we have, it's really important for people to realize people always are talking about the free market economy. They talk to you about this all the time. And it's actually not true. It's a thing of history. We don't have a free market economy. If we had a free market economy, the market would be left to fix imbalances. And we don't have that. We have a managed economy. And with a managed economy, what we're doing is we're trying to engineer an outcome, a certain outcome all the time. And so we put a little of this in and take a little of that out. And we're always trying to kind of manipulate this thing. And so what people need to understand right now is we push things a little too far. And so what Powell's trying to do is he's trying to pull a lot of heat out of the U.S. system without causing problems. And so far, it's been working pretty well. I mean, the Federal Reserve balance sheet's coming down. It's coming down a little bit. It's not coming down a lot. And there's money coming out of the system. Some of the hot money's coming out. Some of the worst kind of banks and projects, business projects, real estate are coming down. Starwood announced today they're in default on an office tower in Atlanta. A lot of these things that are coming up as defaults are buildings that you wouldn't want to buy to begin with. I mean, one of the things we've written about in the Tucker Letter is that a lot of the people that are defaulting on these, they would never have actually bought these products, these buildings, if they were buying them with cash. They were only doing it because the money was free. All right. So Powell's trying to reverse this. Now, how far can Powell go? Well, I encourage people to watch things like, for example, automobile sales. Now, I have a couple cars. I bought a car during the time when cars were rare. Okay, so I remember I bought an Audi. I went to the Audi dealer. There were no Audis. There were zero Audis. And the guy's like, we have one car that you want, and you got to pay MSRP plus an extra $5,000 fee. So I said, okay, fine. But now if you go to the Audi dealer, they actually have a lot of cars. And if you go to a lower dealer, like go to a more active dealer, like a GMC or a Chevy or something that has they have lots of cars, and they're starting to offer incentives for you to buy cars, right? Remember before they used to say $1,000 off, whatever. They're trying to do that again. And so today numbers came out that have them on the Bloomberg where car sales were lower than expected. That means incentives are going to go up. That means your trade-in is worth less. That means the guy at the auto dealer that sells you the car makes less. Okay, this is how things work. So the Fed is going to keep this up. Now, why is all this happening? Well, partly because to get an auto loan, you might pay 10% now or something, and you were going to pay 4% during COVID or whatever. So this is how things happen. It's a slow motion process, and it's happening like this. How long will the Fed go? They'll keep raising rates until there's a panic. Once there's a panic, they'll turn around and they'll start some version of QE that's got a different name. It'll be something different. It won't be exactly the same. But my point is that they'll try to manage the system. They'll try to, it's kind of like managing a hangover or something. I mean, you're managing, you're having excess, and then you're trying to manage the downswing and then send it back up and then back down. It's very difficult. It's very difficult to do this. Everyone knows this in real life, but the Fed is trying to manage this, and that's what people should expect next.
So you brought up cars. So let's talk about interest rates. So let's take cars as an example. When can we expect car lease rates to go down? Same with mortgages. Any debt. Can we expect interest rates to go down soon?
No, not soon. I mean, so the housing market is still somehow holding itself together. I mean, that's what's bizarre is my friends in Toronto and Vancouver, they're all scrambling around, trying to lock in, rates and do all these different, because they have these variable rate mortgages, right? It's now eating all their income, and then the price is coming down. And Trudeau says, well, maybe we'll make the loan longer or something. I mean, there's all these shenanigans. You're not seeing real. It's not going to come back down until you see real panic. So you see people really, right now, people are still spending through their savings. They're still hoping maybe the rate will come back down. It's not going to happen. Now, once we have an actual panic, see if you notice right now, these buildings that people are defaulting on, it doesn't really matter. Like I wrote a story last week about how there's 19 hotels that this one investor just turned the keys back in for this. Nobody really cares, right? Because this is like a Hampton Inn or something, DoubleTree on the side of the freeway. And, the bank will take it back and they'll sell it. They'll lose $200 million on the portfolio. Nobody cares. But when this starts happening in mass, all right, and then remember, the private equity funds aren't able to roll over into new deals. The real estate investors aren't able to roll. Oh, wow. Okay, now it's becoming a real problem. Second half of this year, it's going to become a real problem. And people will start to see this. The market will discount it. The Fed is done when there's an actual panic. So what does that mean for investors? It's so easy. It's so easy. People that read the Tucker letter know this. It's not a time to gamble. You get your hands chopped off if you're trying to gamble. This is not a time to gamble. And what's the evidence of that? Your friends that are gamblers, ask them, how you doing with your gambling? Not great, right? Not great.
Wait a minute, when is a good time to gamble? I'm not saying you said now, but just hypothetically, when is a good time?
So take yourself back to 2020, 2021. People are sitting at home. They get free money. They start throwing it in Robinhood accounts. Anything you touch basically was getting hot all the time. I mean, you would look at somebody tell you about some SPAC or whatever. What do they do? It doesn't matter. Boom, it's up. Everything that you're kind of throwing something at. And that's because it's so easy to explain why that was happening. Is because you had all this money, these new gamblers showing up at the casino gambling. So when you have that, there's so much money. Now you have the opposite. You have people leaving the casino. That's what you want to gamble when you see people trampling each other to get into the casino. When they're all leaving the casino, you get out of there. It's not a time for gambling. And that's what we have right now. People are leaving the capital markets. And so that's a time. Now you can buy stuff. I mean, in the Tucker letter, we have trustee portfolio. It's doing amazing. We're buying companies that make money. They're buying their stock back. This is a trend that we're seeing in the portfolio. They're buying a lot of stock back. They pay dividends. Stocks are going up. They're in uptrends. But some of these things are boring. People don't like them because they've only gone up 25% since April. That's not enough for people. Okay, but the reality is that this is a time to buy sound things that you want to own. I mean, the premise is, am I an owner of this company? I try to explain this to my kids, get them a little stock. We're like, you own this company. You're the owner. Now, people don't care about that, right? They say, well, what do I want to own? I just want to gamble, right? But when you own a business, you think about things differently. You think, do I want to own this business? You don't really care if the stock price is 1% higher or lower or something. You care, do I want to own this business or do I not want to own this business?
I'm going to come back to how you would define a profitable business and what to look for. But first, you mentioned something very important in your newsletter. You mentioned several of the tech companies have gone up a lot this year. Meanwhile, you said old line businesses like energy producers, industrial companies fell behind. You named a few. Yes. So we've got two ends. We got a K-shaped kind of thing going on in the market. You've got tech doing well, some of the things not doing well. Can you explain this divergence?
Well, tech is hot. I mean, everybody's kind of concentrated into tech, and it's not that many stocks in tech that are hot. It's only about 7 or 8 stocks in tech that have attracted a lot of attention. Now, what I think is going to happen, and the next 2 issues of the letter, just a little teaser. I've been in Japan for half of July, and I'm writing about a lot of things going on in Japan. And part of what I'm interested in Japan is that they had this lost decade. It was really like a lost 20 years. Like the Nikkei hit a high in the late 80s, and it's barely just now coming back to that price. What that means is it really went nowhere. So what I'm kind of saying to people is like, okay, I mean, NVIDIA is a great company, but what if you're paying a price for it where it's not going to really go anywhere for 20 years? Are you prepared to wait for a return on your capital for 20 years? People would be like, no way. You know, I can barely wait 20 seconds to see if somebody liked my Twitter post. There's no way I could wait 20 years, you know, to something. Okay, well, think about that. You know, do you want to really own that? Is that really what you want to own at this moment for those reasons? It doesn't matter that the company's got the best, you know, generative AI chip that's on the market right now. It doesn't really matter if you're paying a price for it. That means you're going to have to wait 20 years to see a return. That's not cool. I mean, how are we going to advance ourselves if we pay that kind of price for it? And so I think people have not really considered this. There's a lot of hot money chasing return in those 7 stocks. Meanwhile, there's a big piece of the market that is productive and the businesses are making money, and they didn't get super inflated by the Federal Reserve's, you know, money experiment. And that's where I've been focused personally. Now, just to be clear, you have to have, for a balanced life, you do have to be exposed to things that are potentially going to give you an outsized return, like a wealth creation. And I mean, as you know, like I'm founded the royalty companies, which for me is like right now, there's never really been a more interesting time. Like Mattel announced special dividend. I don't think people really noticed that, but there was an asset they paid virtually nothing for that Barrick came along and bought for $5 million. And that's pretty wild, right? Because I mean, you did all this work 5 or 6 years ago, and all of a sudden, some of these things are starting to sprout up like trees, like you're ready to harvest them. And so, I think people need to understand that, and that's what I do in the newsletters. I'm like, look, I mean, you have basically your core, you have the things you own, and then you have your speculative things that you're doing that give you potential for big upside. You got to have both of those. I mean, really, it's like that's like a proper structure, you know, for your financial life. Has a foundation, has strength, and then it has areas to speculate. And so once you have that, you're a healthy speculator.
Well, what's more likely to happen, that the stocks that didn't catch up to tech, if you want to call them undervalued, I don't know if you want to use that word, they're going to catch up? Or do you think the rest of the tech sector, the stocks that you mentioned, the couple that were hot, they're going to come back down?
I just think it's going to take them a long time to grow into the you know, they bought, like, remember when you were a kid growing up and your parents would buy you like a outfit that was too big, and they'd be like, it'd take you a while to grow into this thing. So you kind of look pretty dumb for a while, you know, walking around it, but then you eventually grow into it. I think it's going to take them a while to grow into those valuations, because there's just no reason to pay $1 trillion for a company, you know, and pay 30, 40 times sales when you could buy a company for like 1 time sales that has double-digit profit margins, pays a dividend, is buying its stock back, and doesn't really have much debt. It's crazy. I mean, it doesn't make any sense. It's like, why would you? I mean, it's just, and these stocks are moving, by the way. I mean, they're not like, it's not like it's some stupid value story where you got to like own something forever and never make any money. I think these things have been so lost in the mania in the US that there's really good companies that are on sale, and private equity is really in trouble because the cost of capital, the cost of debt has gone up so much. And that private equity lost some advantages, tax advantages, with how they deduct interest. And I think you're seeing them really struggle. And people are like, well, what does that have to do with me? It has a lot to do with you, because, for instance, I know in the US, if you call a local plumbing or AC company or something, there's a really good chance they were bought by private equity. I mean, if you go to a local store, there's a really good chance it's bought by private equity. Like, private equity overlords own pretty much everything. And all they do is they take a little bit of equity and then they borrow a huge amount of debt, and then they buy everything in your life, and then they ruin it. They just, like, what they do is that they get rid of all the smart people that ran the plumbing company, and then they hire, you know, a bunch of like low intelligence people that will operate off the name that the local plumbing company built. And then it takes people forever to figure it out. So they strip the business of expenses, and then they sell it off to people. My point is that this has been going on for 25 years in the US, and it's really hollowed out the economy using debt. But the cost of debt now went up tremendously. And so these groups are struggling, and they're like, wait a minute, We actually have to run the plumbing company. We didn't want to run the plumbing company. We just wanted to buy it and flip it to somebody else. That's the mentality in the US. And that's what is right now under pressure. And so I think when people look at what the Fed's doing, the Fed is going to keep raising until there's a panic and until people are having to liquidate these investments that they really never should have bought. And then you're going to see something shift. And when that shifts, I mean, the gold price probably goes nuts. In fact, it probably goes a little nuts before that happens, because if you notice, gold is good at sniffing out what's happening. I mean, it's good at seeing in advance what's coming down the pipe.
I want to come back to gold in just a minute. I have a question about gold stocks. But in your newsletter, you said that profitable business models to thrive. You don't have to give specific names. What kinds of businesses are we talking about? Which sectors are more likely to be profitable going into the rest of the year?
Yeah, so we as you know, the subscribers, there's a lot of, you can read a lot of the Tucker letter for free. I mean, people go to ebtucker.com, they can read for free. It's really great. But the subscribers there is a portfolio that I run for a trust, and I put that portfolio in there. So I mean, we've just what we've done is like take in the oil business, for example. Offshore drilling has been like an amazing business. We bought that in the spring. We kind of told people like it's not that exciting, but the bottom line is that there's not enough ships, and it costs like $1 billion to build the ship, and nobody will build you the drilling ship, which means there's not enough, and there's high demand for them. People are paying $500,000 a day to rent the newest models of these things, and the company's all like restructured. And so something's cooking in this industry. Sure enough, they've started paying dividends. They've been buying back stock. Stocks are all going up. And imagine they're going up like crazy in this market that's not really, other than AI, not really that exciting. So my point is that you've got these types of businesses, and we have more than half a dozen companies in the portfolio at the moment. And it's that one's a great example, because that's what we're looking for. We're looking for businesses that make money, that have improving business conditions. And when I say that means sales are going up, competition is low, and interest rates are keeping competition out, if that makes sense. So that's kind of what we're up to. And so far there's been plenty of things to go after, and that's the long game, right? I mean, that's what you do with money that you don't want to lose, right? I mean, that's what you do when you're managing your wealth. You're not out there gambling. Now, there are opportunities to gamble right now, because, for instance, we're really overdue for a commodities rally, big time, as you know. And so that's a market that's been very, very quiet. And I love copper, and I think that copper is interesting because Newmont, buying Newcrest, and Barrick trying to buy First Quantum. There's been like aggressive takeover moves in that business, which normally sets off a lot of people's kind of radars, and they start focusing, but it's not happening. And so you can see in that business that there's something is coming down the pipe, and it's about to get very exciting. So I think there are opportunities that people should be aware of when it comes to speculating. It's just that it's not a time to be recklessly gambling.
Well, speaking of oil and gas, how do you feel about energy right now? It's come down a lot last year. Biggest drop in the CPI components of the CPI components. Yeah. Is the biggest drop. What's next?
It's firmed up big time. Oil had a big day today. I mean, it's 75 or so. I mean, I think probably like between 80 and 100 is the right price for oil, for sure. And I watch a lot of the Saudi commentary. The Saudi, is warning speculators around the world that are short oil that they don't know what they're doing, and I think that matters a lot. I mean, I think with oil, it's a very complicated, gigantic market. You're burning 100 million barrels a day. It's like a number that people can't even kind of conceive of, really. The oil burn in the world is tremendous. So, there's been certain opportunities, like the energy producers are probably pretty good. We've got some exposure there. The offshore drilling, we like that. And I think that oil is probably a place where, if you have stocks you've been watching, we like them. I own them personally, and I like it. But yeah, I mean, this is a type of thing where you've got things that matter, like things that you need to produce. And I don't particularly count agriculture in that in that sector. I mean, I think, we have a tractor company in the portfolio, but I don't really count like actual produced agriculture because there's been a lot of innovation in that business. Like there's been a lot of genetic modification and efficiency brought to agriculture, but that hasn't happened with mining. And I think mining's pretty crude, and you have just a huge deficit in copper production. And then I think the money problems that the U.S. is facing are the background case for gold. But by the way, I am going to write next month about what controls the gold price. This has been a question that people always are asking me, and I actually know the answer. So I'm just going to write about, I'm waiting for to go on a trip with someone to get some pictures, but I'm going to write about why does the gold price move and why does it not move? And I think people finally, they'll be able to put that answer to rest and realize the mechanics of how it works. So.
Oh, okay. All right. So I guess you'll give us more details.
You'll have to stand by. You have to stand by for that. It's not, but I think people have always asked me this, for years, because if you look at the gold chart, it's really interesting because it actually has done great. Like if you go back to 2000 and gold was $300 or something, it's actually done great. If you just, if you bought some gold then, your wealth has actually been preserved the whole time. It's just the most boring thing you can possibly do because it seems like it never goes anywhere. But that's because it sits somewhere and then it takes a little step up and then it sits there for a while. And now it's time for it to step up into the 2000s. It's really time for that. And so it's sitting right there for the third time. It's trying to break 2000. If you look at the chart, it's 3 times it's tried to break there. So it's a matter of time. And so then it's going to step up over that and it'll be there for a while. And so while everybody's looking for the next hot AI chip stock to buy or whatever, this market is telling you hey, it's a forgotten market. Nobody's interested. And it's time for it to move up a couple $100. And that's coming. And then there's what do you do about that? Well, it's what you do is that what E.B. Tucker does is have a gold royalty company. I mean, that's the way to do it, right? I mean, and nobody's interested in the gold royalties. Metal announced special dividend. People say, who cares about that? But you look and you just say wow, I mean, who cares? That you want to hear people say, who cares? It tells you that you can buy something cheap, because when people are really excited about something, it means that you're going to have to pay a lot to get it. So I want to hear people being negative. Yeah.
Why is it the gold price has done well, but the gold stocks in the equity side have not performed as well relatively? I mean, Metalla royalty stock done very well overall, but this year underperformed gold by just a little bit, even though,
definitely.
Same with the other gold stocks.
And to be fair, last year too, same thing last year. So look, I'm in that business. I've been in that business. And what shocks me is that when we were out, we have about 80 something royalties. When we were out buying them, the stock was much higher. And now that we own them, the stock is much lower. It's really bizarre. But there's not an institutional interest in gold at this moment. And you have to remember that back in 2011, when those stocks went crazy, there was a lot of institutional interest. And then we had a long bear market and they went on to do other things and they haven't come back. So what that tells you is that in any sustained move in gold, you're going to have so many people trying to come to the gold party that you're going to have security at the door, because nobody has been at the gold party for so long that nobody even knows where the gold party is located. Okay. So it's like a speakeasy for gold. There's people who aren't going to know how to get into it. And I know that because I'm in that business and I'm with those institutional investors and I'm talking to them and they're not involved. And so if they're not involved and if the average retail stock buyer is being squeezed, you got nothing, right? Because I mean, who else is going to buy the stock? If retail's not going to buy it and institutions aren't going to buy it. Nobody, and to your point, it's not just Metalla. Look at all the stocks. It's all the same. They all have the same chart. And so there was some COVID era enthusiasm, and then that's waned. And now companies have done all this hard work and you can buy the stocks. You can look at the stocks and they have all these royalties and the stocks are lower. It's almost like you can wait for them to do it. It's kind of like, remember when a mining company finds a deposit and the stock shoots up? and then they spend like 3 years getting the deposit ready to build, and it goes down, and then you can actually buy the producing mine for cheaper. Remember this? It's really crazy. Everybody knows everybody in that business knows what I'm talking about. It's like you have that enthusiasm, then it goes away. Nobody's paying attention. You can buy it, and then boom, it's actually producing, and some other company buys it. And you're seeing all this consolidation. You're seeing big companies buy viable deposits, and that's a big deal. I mean, there's not a lot of gold companies for people to buy at this moment. There's been so much acquisition. Yeah.
EB, is there a definitive relationship between gold and the Fed funds rate? Last year, gold was kind of flat, even though the short end of the curve kept rising very dramatically, as you know. This year, gold in 2023, gold rose above $2,000 while the rates continued to go up. So,
Yeah. So the thing that's weird about gold is, and I'm going to explain this next month, is that it almost has nothing to do with supply and demand. It's really strange. And so, you have the things that I watch, just so you know, is like Singapore has bought, last I checked, 70 tons of gold this year, and Poland's bought a lot of gold, and Turkey's bought gold, Russia's bought gold, China's bought gold. And then what's more interesting to me is a lot of these countries have pulled their gold out of London and New York. That's really strange, I think, is that they've all pulled it out of there and they want it physically. But the average person, they have no idea why they would even want gold. I was just in Japan, and I went to a department store. They had a gold section where they were selling all these different gold. It was really fascinating. It's quite expensive, by the way. I was doing the math. It's hard to do the math when it comes to gold price in yen, because the numbers get really crazy. But the price was, maybe 2.5 times the actual physical cost that people, if they subscribe to my letter, I have my gold dealer in the portfolio, that the price in Japan was much higher. But my point is, there was a little bit more of an awareness. You would never go into a Macy's and see a gold department. Think about that. Like nobody would expect that in the US. But in Japan, in this department store I was in, they had a gold section. It was pretty cool.
Like, I'm just visually, what does that look like?
Yeah, they had security. Yeah, for sure. Yeah, they definitely had security. There's people kind of watching you, but you could actually go in there and, for like, 100 million yen or whatever, buy this like big pieces of gold and different, they were like stamped with stuff. It's kind of like one-off coins or something like that had interesting designs. But people were in there, by the way. I went in there. I got pictures of myself in there.
What are you going to do? You're going to put that in your shopping bag and walk out of the mall with some gold bars?
Yeah. Well, I mean, the thing I'm always telling people in the US about gold is like, probably no one's they're more likely to steal your iPhone than your gold, because I think nobody's really thinking you'll have any gold. They don't really know what it's worth, and maybe a gold chain, but like if you have like 2 or 3 coins, I think people are kind of like, what's that? It must be a souvenir or something. So yeah, I mean, the point is, you were talking about the funds rate. I don't really think there's a correlation there, because I don't think gold functions like a hedge anymore. I think the days are over. And I think people should realize in the 70s, people bought gold as an inflation hedge, but most people that did that are dead. So, I mean, you have to remember, if you were 40 years old in the 70s, you're in your 90s now. And so that's a long time, right? And so if you're in your 90s, chances are you're enjoying watching the prices right every day, and you're probably not like a super active investor. And so 50 years is a long time. And what that means is that I don't think the correlations are the same, and I don't think gold functions as a hedge the way that it used to.
There's this talk of the BRICS nations looking into creating a gold-backed currency. This has, been reported, and I've yet to actually see this actually take place. So, is it happening?
Yeah, I think so, but I don't think it's what people expect. Like, I think people think about that in a way that's like there'll be like a gold standard or something. It's not like that. But I think what the BRICS, let's call it the global South, because basically it's more than just the BRICS. There's a lot of like countries that are in working agreements with the BRICS countries, and basically what they're doing is they're trying to de-dollarize. And I think what they realize is that for people to take them seriously, they need to have some gold. And so what that means is that, if they have some part of the reserves in gold, then they have the ability to establish themselves as something that can be taken seriously. And it's not all gold. It's just that a portion of that needs to be backed in gold. A portion needs to be backed in some sort of produced physical commodity. And you're seeing this a lot. You're seeing a lot of bilateral agreements be signed. I think you're going to see a lot of these cooperation agreements happening. And what does all this mean? Well, what it means is that the U.S. for a long time controlled the world's oil supply in the sense that all the oil that turned over in dollars, and a lot of those dollars washed back through the treasury market. So there's a lot of this was their 20th century setup, was this is how the U.S. kind of controlled the world financial system. And I think you're seeing all these groups try to get away from that. Now, it takes time to get away from that, because it's not like some sort of instantaneous thing that you do. It's like a long breakup or something. It takes time, and that process is underway. And I'm not sure that the U.S. thinks that it can stay king of the hill, and maybe it can. I don't know, but I think that this is a time where it's really sensible to look at owning some gold, because we are definitely in a place where holding the gold price here is going to become very expensive. I don't think they can do it.
And they're not gonna. It's not like they're going to go acquire physical gold to make this happen. Maybe they are. I'm talking about the
BRICS
countries.
Get it.
You can't get it.
Yeah. So think about Singapore's buying 70 tons. It's really hard to buy, 70, 80 tons or 100 tons or something. I mean, you have to like really. And in the newsletter, I showed pictures of visiting one of the largest refineries in the world. I mean, I saw like on a pallet, I saw a ton of gold. I mean, it's pretty impressive. It's not that much material, but to get yourself, if you're a country that wants to buy 100, 200 tons of gold, I mean, it's not easy. It's not like going to the department store in Japan and buying it, in that kind of quantity.
Put it this way. So if you had some amount of cash that you had to park away for 25 years and you can't access it until retirement, you're not allowed to touch it, where would you feel comfortable parking that cash? You can either put it in your bank, put it in gold, put it in some other asset, whatever you want.
I kind of do have that, because I'm the trustee of a trust that I don't benefit from, of course, and that's part of what I started in the portfolio in the newsletter. It was exactly that premise, was that if somebody gave you money to manage for 25 years, and you didn't have to hit the ball out of the park, but you can't lose money. It's bad if you lose money, and you can't be in a position where you lose purchasing power. You kind of have to preserve. You have to preserve this money. What would you do? And I think gold is a piece of that equation. I think it's a much smaller piece than people would think. And I think stocks of a certain variety are a piece of that equation. There's a lot of things that go into that, but where I'm useful is the gold piece and the stock piece. I mean, when it comes to like buying farmland or something, I'm not really the guy for that. And believe me, people watching, when you start thinking about yourself as a trustee, instead of thinking about yourself as like a desperate gambler that's trying to make their life better with little work, you make much better decisions.
Well, what about just the overall stock market index? I mean, if you take a look at the S&P 500, it's never been like Japan. We've never had a 20-year period where it's been flat. I mean, I'm talking about 20-year period.
We've had over 10 years. I mean, we had like, if you look back at like the 60s and halfway through the 70s, this was a kind of a go nowhere period. And we had all these like Nifty 50 stocks, if you remember this. We had all these like hot stocks that people, ITT and IBM, and these were all like forever stocks. And a lot of them went nowhere. They actually went nowhere. So, I mean, even with dividends included, you waited until like 1982 before they really started moving again. And then they moved a lot. So I think you can definitely have a period. Let's not get hung up on the time. Like, I mean, it could be a decade. It could be so much inflation that it starts to look like it's moving, but it's not moving. That's another problem. Is that it kind of like treads water for a long time. But there's some parts of the market that I think would not behave the same way. I mean, you take the thing about the gold royalties that I like with Metalla is that like the gold royalty business has not seen new investors for like maybe 12 years. Okay. So think about that. I mean, 12 years of if you're 34 years old, that means you work for a hedge fund or something, you've never been involved in a gold stock. Never. So I mean, that's a long time, right? I mean, think about that, and that means that when that turns back on, because after the lost decade in the U.S., like till '82, stocks went totally bananas. I mean, they all you had to do was buy them; they went up for 35 years, 40 years. So sometimes it's fun to look and say, what are the sectors of the market that have been forgotten for a long time and really forgotten? Where if you went to a party and you said, I just bought this gold royalty stock called Metalla, people would be like, that's ridiculous. So knowing nothing about the company, they would just say like, who would buy a gold stock? And what's a royalty? That's another question. What is a royalty? When you hear that, you know that you're looking at something that's been forgotten, because a royalty is great, especially in an inflationary environment. If you have inflation and the cost of everything go up, the royalty just floats right up with it. It's like a ball floating in a pool. It just goes up and up and up. So that's the way I see things, and it's worked out pretty well for me. And usually when other people are upset, I'm feeling excited, and when other people are excited, I'm getting worried. You see how it goes? And so now is one of those times where everybody's feeling upset and worried, and meanwhile, Metalla's paying special dividends. It's crazy. I'm thinking, what do you, this is nuts. Like, I mean, this is really good. Probably if this is a trend, I love to get involved in trends early.
I'm last part of our conversation. Last time we were talking about how you're looking for a swimming instructor. I'm going somewhere with this. Have you found him yet? Yeah.
Well, no, I moved on to playing more tennis. So I've been playing a lot of tennis, and in Japan, I use Yonex tennis gear, and I own Yonex stock, which you have to buy on the Tokyo Exchange. And I think Yonex is the best tennis equipment. And in Japan, I went to the Yonex corporate store and got another racket, and they strung it for me and everything. I got a picture in there. I'll put it in the newsletter. It was really fun. But I do have a tennis coach, Jonathan. I think I'll put him in the letter at some point too. But I'm playing a lot of tennis right now, but I don't have a swim instructor. It was too hard. But I'll come back to swimming maybe when it's not so hot, like maybe in the fall or something. But right now I'm playing like a bunch of tennis. Yeah.
It just makes me think, you're looking for someone to help you out with a particular sport. Maybe there's a lot more demand for jobs out there than we think. Maybe the unemployment is low because the labor market is strong. Maybe we are headed for a soft landing. I don't know. I'm just speculating. What do you think?
Well, back to tennis. Like, if I was trying to get a pickleball lesson, I think I would probably be having a harder time. The pickleball seems to be overtaking the world of tennis. But as you know, I kind of like old school things, and so I like, the more people play pickleball, the more I like tennis. And there are tennis instructors out there, because I think the pickleball wave has caught them off guard, and they've kind of wondered, why are they taking all the courts away and making them pickleball courts? But so I tend to gravitate, like any rational consumer, I tend to gravitate towards something that I enjoy, where you can access it. If you can't access it, it's no fun. It doesn't make any sense, right? But tennis, drive around, everybody watching, if you drive around your town, notice maybe you used to be 4 tennis courts. Now they've 3 are pickleball, 1 is tennis. And it's kind of interesting to see. And there's like pickleball leagues and everything. But I don't play pickleball. I don't like pickleball.
Yeah, it's too bad we can't invest in pickleball. But
well,
overall,
by the way, Yonex makes pickleball equipment. So I asked the company that, when I visited, I asked them, they said, yeah, we make pickleball equipment. And so I bought the stock. So
but
they
overall,
do make the best rackets, I think. Yeah.
Just to close off on this, overall, are you worried about the unemployment rate going up dramatically?
Well, I'm not worried about anything. I mean, or the things that I am worried about are totally trivial and unrelated to money matters. But I'm not worried about anything, because I think that the Fed is going to keep going until people just panic, and they're not panicked yet. They're not panicked yet. I mean, believe me, like I'm watching, and the U.S. is the only place that has this stupid thing going on where like you can't get a dinner reservation and all this stuff. I mean, Tokyo didn't experience any of this. I mean, you can just go, everything is groovy there. I mean, you can go right in and eat somewhere.
What do you mean you can't get a dinner reservation? What?
Like you go to a restaurant, it's not even a good restaurant, and it's like full. I mean, and then, yeah, I mean, it's bizarre. I mean, you think like, well, you have no tables. And you're thinking, if it wasn't for my dinner guest, I would never even be here, you know? And so it's really strange in the US. Like it's just this odd climate where things are packed, and they're not even high quality things, and they're packed, and people just seem to be spending with reckless abandon. And so I think they're going to keep spending until they run out of sources of cash, and that's coming.
Okay, that's coming.
Yeah.
All right. Well, let's.
Yes, it's coming.
All right, let's follow up there, and maybe we'll talk about gold next time in more detail when you write that piece up. Thank you. Where can we read your work, by the way? Where can we follow this gold report when it comes out?
ebtucker.com is the best place. It's so easy. You just sign up. You're not going to get any marketing. You're not going to get any tacky ads. It's only me writing every other Thursday. So you get every other Thursday, you get a note from me. I write it, I edit it, I do everything. So if you find yourself wanting to complain to the comment section, just remember it's only me writing it. But I think people have enjoyed having a direct connection. I don't write anywhere else, as you know. I don't have any other I don't have any other place where I publish. It's just ebtucker.com.
Sure. All right. Well, we appreciate your thoughts. Thank you very much, EB, for coming on the show today. Appreciate it. Thank you.
Thanks, David. Talk to you soon.
Yeah. And don't forget to subscribe. Thank you for watching.